The more you combine things, the better filter you will get the probability of winning trend. There we come to divergence. We learned how we can use bike indicators. One function of indicators is divergence, which we did not discuss before. Now, what does divergence do for us? Divergence helps us in spotting trend reversals and trend continuations. Now, how do we support divergence? Identify it. We compare the movement of the indicator, for example, RSI, MACD, stochastic, whatever it was, with the movement of the price on the charts. Now, what is their advantage? Their advantage is they give you role as E-points. They help you a lot in identifying tops and bottoms and good entry points. So they have a very good risk to reward ratio and divergence of two types. One, we have the regular divergence. The other one is called hidden divergence. Now we will come to regular divergence. Regular divergence, keep in mind, is always used only and only to identify trend reversal. It has no other use than regular divergence to indicate nothing to a trader. So for example, what will bearish divergence be? The price has made a low and a lower low, and when I look at the indicator, a higher low, then what will happen with that? That indicates that we have a divergence coming. The date will be bearish, so it indicates that the price will go up. Similarly, there is bearish divergence. Now what will happen in that? In that, the price will make a higher high. The indicator will make a low and a high. Now what I will find out from that is that a divergence is coming in the price, meaning this move that happened is a fake move, and most probably. After this, we will continue the downtrend. The downtrend will start. So this helps us in catching the top and bottom. And you can see the example. What is hidden divergence? Hidden divergence is the deposit of divergence. Now, what was divergence? The price is making higher highs. The indicator will make a higher low, and a regular divergence occurs at trend continuation reversal, while hidden divergence helps you understand trend continuation and helps you identify that this collection happening is a sudden move or sudden collection. This is just divergence fake out, just sudden impulse collection. The price has to go back up. So what will be a bearish hidden divergence? The price makes higher, which means your indicator rolls, and what will be bearish is that the price is making a roll high and the indicator is making a higher high. So you can see examples, look at them carefully, understand them. These are very important because they make your life much easier. It is essential to know divergence along with price action. An example is in front of you. Regular divergence. Here, the chart is also showing divergence. You can see that the chart has made a roll, but the stochastic indicator has not made a roll. Now, what does this mean? Now, this probably means that a breakout upwards has occurred, leading to a reversal. So the downtrend has not ended. And after stabilizing, the price starts moving upwards. In this, you can also see the use of trend lines or also use candlestick patterns. So we have to use everything together. We have kept this in mind. Similarly, there is an example of hidden divergence. Here you can see that the price has made a roll high. The indicator has made a higher high, indicating that with a slight move, the indicator has gone into overbought, meaning that the correction that happened is just a correction, not a reversal in price. It has to go back down. So what do? We place a sell order and it goes down. So always we have to keep an eye on divergence. And divergence is a very important thing. We always have to wait for them. If we don't wait for them, what will happen? You will enter early, enter. Where our profit is made, we will enter there, and where we had to enter, we will place it from there. So most probably it will happen for us. So we have to time our entries very well. For example, if you are using stochastic, we will also draw the trade divide indicator. We will also draw on the chart, wait for the trade to break, not just when the trend line breaks. We will maintain it. Similarly, we have to draw the trade line. If we are using MACD, we have to wait for a crossover, or if we are using stochastic, we have to wait for a crossover. And if we are using RSI or stochastic, we will have to wait for the price to move out of the oversold or overbought territory. When it moves out, we will enter. So we have to keep an eye out for these things. So now the other thing is identifying price action. Now what do we have to do? We will discuss the rules for identifying divergence. Rule number 1, ensure clear higher high and roll, double top and double bottom, and we have to identify that we do lines connecting this successful high and roll, and 3, connect wholly. So now what do we have to do? Finally, you can see we are connecting only major tops and bottoms, ignoring minor fluctuations. Keep this in mind both in the oscillator and in the price action. Then what do we have to do? We have to compare the price, keep an eye on both the oscillator and the price. We have to observe their highs and lows and try to be exact. So we have to maintain consistency in connecting highs and lows on both price and resistance indicators, and their areas should match. Now, where they are not matching, that is basically not forming a divergence. So the indicator should be exactly in the area below the swings of the candles we are trying on the chart. If it is too far back or forward, the data will become invalid. The vertical line between the oscillator, we have to match that area. We have to keep an eye on that so that the swing highs and lows are connected for the divergence to be accurate. And the rest of the consideration is to observe the slope of connecting high and low vaulted trade divergence vergasmi. For example, the move has already happened, some divergence has already played out, a base divergence was formed, the price fell back down, but it doesn't mean that the price will keep falling. So a base divergence had occurred. It played out. Its target was hit. So forget that. Wait for inner divergence. Focus on higher time frame for more revisory signals. The more you remember in trading, the more you go to small time frames, the more fake signals you will get, and the happier the broker will be when your account goes to zero. The more commission they will get. It will play for you. But we don't want to be happy. We want us to be happy. We want the family to be happy. You want to make money by using higher time frames for more revised and accurate signals, because the number of trades does not matter. The profitable trades matter. How profitable can go get in later. The number of trades does not matter. So we have to keep an eye on that. So we were discussing the divergence cheat sheet that we read. The takeaway is that the divergence indicator is not a trade signal. It needs to be combined with other techniques. Not everything is less in this. Patience and discipline are like a Q shave in every trading step.